Hi everybody, Darren here. Look a little bit different today probably. I've got a fisheye lens on my camera which I'm just messing around with, so excuse my very geekish little lens. Just thought I'd come with a bit of an update. There's been plenty, I guess, going on in financial markets, investment markets, and it's probably worth giving you a little update at this point. Here we are in mid-August already. So first of all, I guess the market's still been pretty volatile on the back of the Chinese share market, and as well as this week the exchange rate in China has been moved, so that's had an impact as well on confidence, create a little bit of volatility. We're also, I guess, seeing the likelihood that US interest rates, as I've talked before, are going to be going up. It could be as soon as September, but it really depends on a little bit of the data between now and then, and whether they're bold enough to do it. As I've explained before, these things can cause a little bit of money to flow out of the share market into bonds because their yield will be higher. But at the end of the day, it's relatively short-lived and external to the companies that we're investing in. So we are about to head into report season, which is usually a good time to really get a good idea of what companies are doing well and doing poorly, and really get a good look through the book, so to speak. So it'd be interesting to see results. I'd expect that for the most part we're going to see relatively soft growth, but still growth in many of the companies that we're looking at in terms of earnings growth. A lot of the companies, as you've heard me speak before about, are really global brands when it comes to income these days. You're getting a lot of the companies we invest in are making a lot of the money from overseas sources and not so much from Australia, which is good to a certain degree in that these companies aren't so exposed to the cycles of the Australian economy. They can go and grow their revenue despite the Australian economy being a bit sluggish. So that's pretty positive, I think. You'll also see that quite a few of the banks are actually raising capital at the moment. CBA announced theirs the other day, and the other three have all announced there as well. So these capital raisings are not because the banks have run out of money. They're not because they have any kind of problems or anything going on. All it is that the government is requiring a lot more capital to be held on balance to make sure that if we ever have any more financial disasters like the GFC, the banks are in a really resilient position to handle those times. So having extra capital in reserve makes the banks lower risk. It does, however, mean that extra capital they have to hold reduces the return on equity in the business, because that money doesn't earn a great deal of growth or income for them. So it's a fairly low investment return they achieve for that capital. However, if we talk about the valuation of risk versus return, the risk has come down because the banks are more solid with more capital on balance. So therefore, the return coming down potentially a little bit isn't the worst outcome. It also means dividend policy is quite sustainable because that they're highly likely to continue to be able to do that. Really, at the end of the day, loans are holding up really well for the banks. There's a really low default rate. Part of that's because of the low interest rates, but also because in Australia it's actually quite hard to default on debt without causing yourself grief. So it's pretty good times for the banks. Otherwise, really, I think we're seeing most of the problems being external to the companies, and we're really not heading towards anything that spells out disaster for a lot of these businesses. But again, a little bit sluggish growth compared to perhaps a couple of years ago in terms of the earnings inside companies. But at the moment, there's a little bit of value coming out with a step back in valuations we've seen since March, April, that when the market was at its recent peak. And since then it's come back a little bit on the back of Greek debt, Chinese share market bubble, interest rates in the US, a few other little things, and these are all causing the market to be a little bit off, but that creates as much of an opportunity as a threat, because we're able to pick up some extra investments for people that have got a little bit of cash around. So hope everybody's well. If you're in Adelaide, hope you're keeping dry, and we look forward to talking to you all very soon. Thanks, bye.